I'm Gary Venner, CEO of IFA Acquisitions, and I'm joined by Alex Canham, who's partner of Herrington Carmichael, where we continue our second informative question and answer series under our YouTube channel to provide top tips and market update when selling an IFA business and an insight into the legal processes when buying or selling an IFA business by two industry experts. The title of this mini video is coming up on screen now.
As some of these businesses have been run for a number of years, often we see sellers who have a significant amount of cash in their business. How do you suggest they deal with that and treat that as part of the process?
Well, usually it's too late to take that cash out, and particularly if you're saying it's a substantial amount, and they will be penalised how they get that out. Normally, corporation tax has already been paid on it, but there will be dividend tax is usually the way it comes out, but it can be quite expensive to do that. So, a lot of those vendors in that situation would want to take their cash out as part of the sale. The clear thing there is making sure that how do they get that out, and how will it be treated. Business asset disposal relief, which is 10% tax currently at the moment, whilst that still stays in place, will not accept that if somebody's taking out an amount of cash that represents way over their annual turnover. That's just not going to happen. They're not going to get relief on that. And normally it's around sort of the working capital, whether that's 2 to 3 months worth of turnover. So normally would apply there. But the rest, it should still come out at capital gains tax, which of course is still a very pleasant tax in terms of 20% over and above any other way of doing it. But there are lots of other ways as well. It may be that the proceeds could come out through pension, which would be pension contribution, which is qualifies against corporation tax, so it adjusts that. So lots of different ways can do it. But the key thing, I think, is talking to your lawyer to making sure, how do I get that out and when will it be paid? And bear in mind that some of the cash needs to still stay in the business because there will be liabilities from the previous trading period, the biggest of course being corporation tax usually. So it's about making sure that there's some accounts in place to work out how much is due to the vendor as well.
That's right, and from a legal perspective, as part of the sale process, there will be some sort of reconciliation of the balance sheet. The most common route we see is what we call completion accounts, and that's where there is a balance sheet drawn up at the point of completion, showing all of the assets and liabilities, almost like a year end in effect, and that will then give you a net asset value or a sort of a number that will ultimately dictate what's going to be paid out to you. Now, often buyers will use different methods, which is probably beyond the scope of what we do a whole session on that. But there is generally based on the sort of net asset position or what we call sort of cash-free, debt-free. Ultimately, the payment profile for that is going to be some way after completion. So because you're drawing up the accounts as at the completion date, there will be a window where the buyer typically will do that with the help of the seller's incumbent accountant because they know the numbers. Then there'll be a period for the sellers to review those figures and sign them off, after which the sum will be paid. And typically we would say about 3 months after completion of the transaction is probably not far wrong for probably 90-something% of our transactions.
Yeah. So it's making sure as well from a vendor's point of view that their accountant is on board straight away to start working on those accounts, because else it will just slow that process down.
Absolutely, yeah. The sooner that the numbers can get prepared, the sooner they can be agreed and ultimately paid. So in addition to making sure people are around, making sure you've got a proper formal process for that in your sale contract, and that again it's nice and clear who has to do what and by when, just means that if there are any issues, then it's nice and clear who exactly is responsible for that.
Yeah, absolutely. And we do find sometimes that acquirer does actually put into the contract to leave in some of the cash for a period of time, because it helps them with capital adequacy whilst they're still continuing with that business before it's wound down, and it saves them having to put that on top of the acquisition price. So I think you have to look at the whole sort of picture really and see what is most appropriate, and be happy that you will get it back.
Absolutely.
So Alex, we see most of the deals cash as being the form of consideration. Yeah. So that I think is what most people want. But sometimes there's an attraction there to keeping shares in the company and all sorts of loan notes and options. Tell us a little bit more what you see on the different forms of consideration.
Yeah, so cash is normally always a large component of it in most of the transactions. The key thing probably relating to sort of shares and options and loan notes will be dictated by the size of the acquirer.
Yeah.
If it's a relatively modest size transaction with a business that is also owner managed, doesn't have any sort of private equity input or anything, chances are it's going to be an all cash deal, albeit some of it might be paid on deferred terms. Where we've started to see sort of shares being used is with some of the consolidators who want to tie people in, both to make sure that they are complying with any restrictive covenants and that they're not going off in competition, but also to sort of incentivise the incumbent team to help them grow and go through the next stage of their journey. And it also helps them, I suppose, from a cash flow perspective as well. The concept of options is often used as well with staff. So you will see sort of management incentive plans being rolled out for members of the advisory team who are going to be important on the next stage of that journey, but who might not be shareholders and didn't get sort of a significant capital payment at the point of the initial transaction. So larger sort of consolidators or private equity-backed businesses tend to like an element of shares and options to be involved for retention purposes, and also to kind of make sure that people are equally incentivised on that next stage of the journey.
Yeah, and we've seen an increase in deals actually that are, buying say 75% of the business, leaving 25% in, and actually because of the investment in that business, the 25% can often come out as close to the 75% original as well. So we are seeing a lot more deals, but as you say, they are the larger deals, and I think the deals sort of sub 2 million of consideration value still tends to be a lot around cash.
Yeah, absolutely.
So Alex, from a vendor's point of view, the big concern I suppose is, will I get the deferred payments? Whether that's a 2-year deal, 3-year deal, it is into the future. So how do I make sure that the acquirer will still have enough cash to pay me and I get the full amount out? How do we protect a vendor in that situation?
I think the first thing goes right back to the beginning of when the transaction is sort of agreed in principle, is doing a transaction with a buyer that you have confidence in and are aligned to, because if you share the values, chances are they will run their business in a diligent way, the same way as you do. But also it starts with understanding how they're funding the transaction.
Yeah.
And what the source of their money is. Is it that they've accrued reserves over years of running a successful business? Have they raised money from their local bank, or have they raised money from private equity or some other sort of debt fund? Because that will all influence your understanding of them, their appetite for risk, their leverage, and just getting a feel for how capable ultimately they will be about being able to make those payments to you.
And is it reasonable to ask the acquirer to show that evidence as well? So show your bank balances, show your funding agreements.
Absolutely, and I think that shows sort of an investment in them as well. So I think it has a positive. I don't think it should be taken as a slight. If anything, I would be encouraging people to be asking for proof of funding if they are raising money. So if this is sort of contingent on an external funder delivering money and that process being completed, understanding what the terms of that are, understanding the timescales for it, looking at their balance sheet, so not just their last annual accounts, but something more recent in the form of management data, I would be encouraging people to do, and really understanding how they're able to deliver on that. Because in practice, security in this sector for deferred payments is very limited. And by security, I mean charges, guarantees, and other sort of fixed security, like a mortgage is the best way to kind of draw an analogy to it, whereby you say, I want to charge over the buyer's business or the buyer's group. The reason for that is twofold. One is often any sort of external lender like a bank or a private equity firm that's putting money in, they will want security, and they will always make it a condition of their lending that they sit as the first charge holder. So any security you get is going to be quite limited, and particularly because the nature of these businesses is that they don't hold lots of stock, they don't hold lots of fixed assets over which charges can be taken. So the security in some respects could be argued as having a more limited value than it might in other sectors. The other one is often because of the way that security can be treated on capital adequacy returns. So a lot of acquirers at the smaller end, even without that external investment and security, are reluctant to provide a fixed security because of the significant impact it has on those Reg Cap calculations and the amount that they have to hold. So in practice, I think doing your diligence and asking the right questions is the first point. The other sort of bits to do is looking at the guarantee. So earlier we touched on if there is a holding company being used, asking for a guarantee from the trading company. That is generally a pretty standard and generally accepted position to ask for. There are other options out there, things like escrow and things that sit alongside fixed security interests, but because the way they tie up capital, often they're not really that viable. That tends to be my experience.
So if we move to the contract itself, presumably there is a breach of contract if payments are not made by the due date.
That's right.
So is that the best protection in a way that they're going to get?
It's certainly the start point, because all roads lead to you having a right to be entitled to a sum of money. And making sure the contract is clear and that the payment date is clear is really important, because if it's an undisputed sum, then in practice you're probably able to put a statutory demand in, which puts a lot of pressure on the buyer's group to pay if you're in a scenario where they're choosing not to pay rather than having no money to pay. It also goes to giving you the options to pursue a breach of contract claim and a debt claim through the courts as well.
And is there an opportunity for them to take the clients or to take the business back if that happens?
Potentially. So even with restrictive covenants in place, one of the security steps that we try and secure if we're acting for a seller is to make sure that those restrictive covenants lapse in the event that payments aren't made within a window of the due date. That's sometimes a more hotly debated point as part of the negotiations, but even in a matter of law, there are arguments that suggest that restrictive covenants may not be fully enforceable in the event that the payments that they were linked to have not been paid. So there's certainly arguments that you'd be able to run to effectively try and recover the business.
Fantastic.
So one of the questions we often get asked is by people who are members of networks, and they want to know whether they're able to sell their business.
Well, generally speaking, yes, of course they should be able to, but we would always say go back and have a look at the contract. It should have been clear in the contract that that the clients belong to the AR or an RI. However, you do need to look at that. We do see a lot of networks still in the small print, so they will write to the clients and notify them that they can stay, because they have signed up with their terms of business for the network itself. So, but majority, we do deal after deal with network members and they all go through very well, but we do get the odd one now and again where the network is trying to hold out that they have some sort of claim, and their paperwork, of course, almost had to have it like that in case that the advisor breached their T&C scheme and that they could continue to look after those clients. But generally, yeah, of course, you can sell your client bank. It does open up a whole load of other things, of course. It's about, will the network play ball when it comes to will they agree to a novation? Some will, few won't. But if that happens, we'll have to look at letters of authority to be able to do it in a different way. But the key, I would say, is yes, it should happen. Subscribe to our YouTube channel and switch on notifications so that you won't miss our next video in the series of top tips and market update when buying or selling an IFA business, and an insight to the legal processes by two industry experts, me, Gary Venner, CEO of one of the UK's largest specialist brokers in IFA Acquisitions, and Alex Canham, partner from Herrington Carmichael, who are leading commercial lawyers specialising in IFA mergers and acquisitions.